Hi, everyone. How's it going? So my name is Joshua. I'm an investor at Truist Ventures, which is the corporate venture fund for Truist Bank. Really excited to be talking about real-world assets and the enabling infrastructure with you guys today. And I'm joined by an awesome panel. So I'll let these three introduce themselves quickly.
Hi, everyone. My name is Sashir from Spectral Finance. We focus on credit risk infrastructure on-chain, meaning on-chain credit scores, risk insights, analyzing wallet transactions, and trying to create this kind of on-chain credit bureau, bridging back into the real world, supplementing FICO scores, etc.
Hi, everyone. I'm Nick. I'm a partner in General Catalyst. We're a multi-stage venture firm. Our current fund is $4.5 billion, and I help lead their crypto team.
I'm Calidora, building Ostium Labs. We are the first perp DEX engineered specifically for off-chain assets, starting with commodities and Forex.
Awesome, thanks. And I think why we're all excited about this topic is because it's a $1 trillion opportunity of assets that are off-chain and public and private markets, which is really exciting, especially since in today's financial ecosystem, many of those assets aren't even fully digital, which is a huge opportunity for blockchain. And I think the best way to kick off our discussion today is, how should we start thinking about evaluating those different asset classes and for tokenizing them, administrating them on chain? And I think, Nick, it would be awesome if you want to answer that first.
Yeah, so I think the clear killer app so far of real-world assets has been stablecoins. So we're the largest investor in Circle. And as we think about the next opportunities in payments, it's really cross-border and B2B. And so there's a huge opportunity to improve the capital efficiency of businesses by having much reduced transaction costs, faster, much better settlement times. And as you think about sort of cross-border corridors, like making those much more efficient today, right? So payments is one opportunity that we're thinking about, in the near term. Alternative assets is another that's happening right now with Securitize. Within the last year, you've seen KKR and a number of other big funds start to dip their toes in. And I think that's sort of a piecemeal process that'll take place over the next 10 to 20 years. But they're dipping their toes in because it can create a lot of value for them, right? And so they've sort of reached the limits of what they can tap into their LPs for. And so through tokenizing their funds, they can sort of expand the pool of capital that they have access to, improve their back office operations, and liquidity for their LPs. So those are some two things that we're thinking about right now, but happy to dive deeper into either.
I think that is really interesting to think about. And Calidora, I know that you have a specific interest in another asset class, but it would be great to hear if you have anything to add in terms of characteristics that you would recommend people think about as they're looking at asset classes and bringing them on chain?
I guess I would think about what problem you're solving for. Off-chain assets that are put on chain don't necessarily have the composability or scalability of digitally native assets. So thinking about what trade-offs and what you're actually solving for in the real markets, our view is that assets that are particularly underserved for retail are the best assets to first put on chain and enable synthetic exposure to. So yeah, I would say thinking about the trade-offs and what the unique benefits are of putting something on chain versus just doing it because there's a long-term view on things will move on chain.
And I guess when we think about how assets will be able to really grow either in distribution or providing a lot more efficiency for the way that there's transactions around them, what are some of the limiting agents that you think are out there today in infrastructure?
Yeah, so I would look at 3 phases in terms of the move towards having off-chain assets be on-chain. I would say in the first phase, the off-chain market is still the reference market. That's where we are right now. So we're building a synthetics market. Feels like a perps DEX, but under the hood, it's actually structured like a prediction market on continuous price movement. There, the limiting reagent in the tech stack is just a great oracle that has less than sub-second latency, provides reliable price feeds for bringing from off-chain assets and allowing you to get price exposure to those on-chain. So that's the kind of first phase of the off-chain market still being the reference market. In the second phase, I would say kind of having a liquid market that is both the off-chain asset is transacted both on the on-chain market, but also off-chain. There, I would say having a liquid bridge. The key thing there is redeemability if you want matching between the on and the off-chain version of that asset. So a liquid and kind of secure bridge, fiat on and off ramping between on and off-chain world is the limiting reagent in the tech stack. And then in the last phase would be much further down the line, but that's when assets will be issued natively on-chain, and those will be the reference point. That's much further down the line. I think will require much more institutional trust in basically issuing assets natively on-chain and having that be the reference market.
I like that last part about institutional trust. And risk management today at typical financial institutions requires so much KYC, understanding if you're going to administer credit, what does their existing financial identity look like? And it makes me think about how new investors or new institutions will get onboarded as these assets become tokenized or are administered on chain. And Sashir, I'm curious how you think about how that identity and risk management will exist when more and more of these asset classes move on chain.
Yeah, I think identity has become kind of a fluid topic on chain. Pseudonymity has really kind of taken over so far in the industry. People are kind of a little weary of connecting back their KYC back to their wallet address. But I think, over the long run, as most of these retail-based apps and institutions start onboarding, most people will actually be funneled into the space through some sort of reputational portal. And so we'll be able to kind of bridge back and forth and blur that line. And that's part of our larger mission is that, right now, all of these Web3 financial transactions are actually just completely disregarded. And so you can't actually include it as part of your real-world financial reputation or your identity, or actually leverage any of those transactions for loans, applications, or anything like that. And so really it's important that we start treating this Web3 financial history as the same thing as your regular financial history, so that it becomes part of your identity. And then in terms of risk, I guess it depends on what kind of risk we're talking about here. Like, obviously there's like security risk, then there's, I guess like recourse. And right now, a lot of this like over-collateralized lending makes sense because of the pseudonymity and the pseudonymous nature of DeFi. If we start delving into this kind of identifiable KYC'd institutional lending and bridging back into the real world, we start to be able to go to unsecured, under-collateralized lending, but it becomes a new lending mechanism itself. And then, we need to start leveraging the efficiencies of on-chain benefits for those same types of kind of traditional, slow lending, like precarious methods. And then finally, there's also ways, we're working with some partners where you can create kind of attestations and proofs instead of kind of, providing all of your assets into a third-party protocol for, let's say, staking. You could actually prove you hold those assets in your wallet as part of your identity without actually manually staking it there and still receive the benefits of it. So if that protocol or platform ends up getting hacked or there's some like attack vector that you don't know about, you don't end up losing your assets. And so that's a big kind of boost for like security where you don't have to give up the custodial rights of them to receive the benefits. And so all of these things kind of fall under identity and risk, but part of our mission is trying to blur that line so it isn't just DeFi versus CeFi, but it's just finance.
Yeah, the DeFi versus CeFi part, I think, is something that definitely comes up here a lot. But I think an interesting point of view would be about looking 5, even 10 years ahead. Is it really going to be DeFi versus CeFi, or do you guys have an opinion if they're actually symbiotic in terms of banks working to integrate this technology, or it's all going to have to be decentralized?
Yeah, I think there's an opportunity for convergence here. So the reality is banks or regulated financial institutions will not interact with DeFi unless there's KYC or AML processes in place or permission pools. Because if $1 is dirty in a pot, the whole pot's dirty. And so I think the future looks like, you have DeFi applications that can sort of be blended with FinTech. So a really cool example of that is Lemon Cash in Argentina, sort of a Web3 bank, looks and feels very similar to the experience you would have on Chime or Name Your Banking app, and they've integrated directly with Aave so that their retail users can sort of deposit assets directly in Aave with having to go to the website or deal with the UI UX experience. And so I think maybe retail users will become outside of these permission pools, but institutions will have to have those permission pools, and you're seeing that with Aave Arc and other things in the industry. And so I think we like to sort of say, oh, like maybe there's a gray area with regulators, but if you're a bank or a regulated financial institution, there's no gray area. So I think there is going to be some sort of a convergence, and that infrastructure, those tools are getting put into place now.
Anything to add, Sachir?
I'd agree directionally. I would say I also would imagine that a lot of DeFi protocols to kind of comply with different regulatory regimens across different countries would have different front ends or slightly modified versions of their back ends corresponding to different jurisdictions, kind of the way you see in CeFi. So I think you'll see a lot of trends from CeFi, kind of this adaptability to different geographies, occur within DeFi as well in the longer term.
Yeah, I agree directionally, but I think one of the biggest problems generally is like when we're bridging real-world assets into DeFi is that we start to lose kind of the benefits of like distributed ledgers and global consensus, and basically the validity of that data, right? So like if somebody is saying this is true in an off-chain world, if we just create an attestation, the only thing you're pushing on there is that attestation, but that validity is living off-chain, and so the point of like global consensus is that you don't have to have that trust assumption. So I would hope that like the trend that happens is that we're not just kind of migrating back and forth without this kind of truth, consensus there, because we've seen what happens over the last year. When somebody just sends an email saying, yeah, I have this much money, okay, now we create that email and put an attestation on it. It doesn't actually bring verification for it. So I think like while we think about bridging back and forth, we also need to kind of not forego the benefits of global consensus.
I also think there are different assets have different bucket of users, right? So Frax, people who are interested in using Frax are very different than people who are interested in using USDC, right? And that'll continue to exist for perpetuity.
I guess expanding on that too, Nick, in terms of asset sequencing, what is your thesis about where the next, in maybe the next year, also beyond that, what asset class do you think will be tackled next?
Yeah, so stablecoins have been the killer app so far. I think what's next there is interest-bearing stablecoins, and the reason why that hasn't happened yet is because it would look and feel a lot like a security, right? And so, what do interest-bearing stablecoins look like in the future? Maybe something like tokenized bank deposits. So I think that'll be coming within the next year or so, depending on the jurisdiction, and like that I think will completely take off. I think what is having sort of limited appeal now, and part of this is because of infrastructure reasons, is like Paxos Gold, right? It's sort of flat in terms of the assets under custody on chain, but there will be a lot of demand for it once prime brokers will let people use it for collateral, right? And so there's like things around the edges that I think will enable greater adoption of some of these real world assets. Other ones that we see in the pipeline, fixed income. There's a ton of value in having a lot of this be done on the underwriting process through smart contracts, right? And I know, Josh, you know a lot about this, but right, getting rid of the issuing and payment agents and making the process for issuing fixed income instruments much faster. So those are some of the things that we see coming down the pipe. Alternative assets, I mentioned earlier. But this is like a 20-year story. And so people are working on it now, and it's not to say that people haven't been, but you have to build the infrastructure around some of these assets to enable them to really take off.
Anything to add, you guys, about just the sequence of assets and what could be next?
Yeah, I would say ones that are currently underserved in the traditional markets. I mentioned this earlier, but commodities are a great example of this. Retail exposure to commodities is pretty severely restricted. Most jurisdictions, very high capital requirements to even be able to trade them in the first place. Amounts of leverage or net position size is entirely fixed. So very kind of little granular control over your exposure while your position is open, very unlike in crypto. So I think bringing some of the properties of digitally native assets to off-chain assets, particularly the ones that don't have or furthest from having those properties in the traditional markets, will be an area of particular interest for investors.
Interesting. I think another one that is similar to that along those lines is around mortgage-backed securities, and it was interesting to learn how many of the transactions that happen today in the MBS market are done on Excel, via email, and these are like huge volumes of data related to individual mortgages and going all the way up to like massive portfolios. So to me, anything like that, that huge efficiency play is really exciting.
Yeah, I mean, with all these assets too, what blockchain has enabled with these censorship, permissionless rails is like having much faster settlement times and reduced transaction costs. Like, still T+2 to T+7 with moving money around the world. Like, if you look at equities, T+2, like, so as these things sort of come on chain, you have much more capital efficient markets and also reduce like risk. So it'll come.
And it also makes me think about, when I'm going down the stack of assets that are out there and how inefficient are, some that aren't digital. And then the term that we've all used, I guess, RWA, real world assets. I'm just, thinking about it, and when I've mentioned it at work as well, people, look so confused, and they're saying risk-rated, a completely different term with the acronym. So I'm just wondering, is there a better name that we could give that also does justice to assets that, are on-chain already?
Yeah, I mean, you didn't even mention that RWA in traditional finance is like a totally different meaning. It's risk-weighted, not real world. I still am waiting for someone to explain what Web3 means to me. I think digital assets is a much better name because that's what it is, right? I don't know.
Yeah, I actually I got into a Twitter back and forth with Luca Prosperi from Dirt Roads. He had a tweet thread saying he wanted to get rid of the term real world assets. And this was a kind of plague upon crypto. The argument was basically that digitally native assets are no less real, that there's an implicit devaluation of digitally native assets by referring to off-chain assets as real. I would agree with that directionally. I just haven't found a snappier term than RWAs. I thought of off-chain, on-chain assets, Okoka, but doesn't really have the same ring. So I don't know. Still waiting for someone to find one.
Yeah, I can't think of anything like better yet, but I do agree that the real-world asset name kind of makes us as if we're not operating in the real world. Digital assets versus non-digital assets also seems to be more confusing. But I think, trying to, actually the mission of everything like we're all doing up here, and I think part of like the conference is actually just trying to make it relatable and usable to the rest of the billions of people that are out there and make these services accessible. So I think that's the goal. And if it becomes a real world and, crypto becomes real world, I'd be happy with that.
Yeah, I guess I'd just add to that options or derivatives aren't exactly like physical either. So the distinction isn't really whether even something is like digitally native or non-digitally native. It's whether it's like natively issued on-chain or tokenized and put on-chain with the off-chain version of it as the reference point.
Yeah, I think this is a pretty big and deep rabbit hole we can get into. I mean, it still drives me nuts like that cryptocurrencies are used on CNBC and they refer to things that are not trying to be currencies as currencies. So like we need to fix some of the basic things for the normies, and RWA can come later.
Oof, normies, that would totally include me, but I won't be offended by it. Another interesting aspect that I'd love to dive into is where you can actually integrate DeFi in brand new ways in different asset classes. So trade finance is an awesome example. I've heard of awesome companies like Crowds is a great example, and they're not only making it possible for more small businesses to get their invoices financed, but then also participate in the secondary market of that. And I'm just wondering if there's other examples that excite you guys or that you've heard of that you'd like to share. Looks like Crowds is it. Only exciting one that we can think of.
I mean, I'm excited about what we're doing because I think it kind of goes the other way. Like when we talk about real world assets, we're trying to talk about like traditional assets in Web 2 and bridging them over to Web 3, but I think there's also a problem going the other way. And so what we're looking at is like credit scores and credit risk infrastructure, but it's actually taking on-chain financial history and bridging it back into the real world. And so then it becomes like, when we talk about we're here in North America, everybody is used to having like a FICO score. And so, the real world is here in the FICO score, but there's like a whole other infrastructure and rails in Web3 that's just sitting there by itself and kind of excluded. And so, those become non-real, right? And that's kind of the problem when we call things like real world and not real. And so we need to actually make those usable in the real world. And also if you think about like emerging markets where there's a high disproportionate number of people interacting in Web3 and using digital assets, they don't even have the benefits of like all these financial services. And so if Web3 can do that, then we could start building some credit risk infrastructure for them, because a lot of these people have never even had a credit score. So again, that's about like bridging on-chain digital assets and services and financial data back into the real world to make it usable and have them more accessible to, I guess, primary financial services.
Yeah, and you were talking about trade finance and factoring, hinting at factoring a bit, but as I think about like how we drive adoption here, it's like how do we also get traditional institutions on board? And there's been a little bit of noise about Visa and MasterCard and these payment networks getting involved with stable coins, and there's real value there both to the payment networks and to merchants, because they're working directly with USDC, name your stablecoin, maybe they issue a stablecoin, they can get rid of payment gateways and acquiring banks, right? Remove, call it 60 to 90 basis points of fees, drive their take rate higher, but also reduce the cost to the merchant. And so it's a win-win for everyone. And so that's like something that I'm interested in sort of waiting to see traditional institutions happen, or get involved with. It's not much that we can do on the investment front there, but I think that's a really exciting way to sort of drive adoption and bring this to sort of traditional settings or financial service businesses.
Yeah, it's a great point. And it makes me think about the fact that there's huge expenses that can be reduced with things like smart contracts and having data available on oracles. And when that happens, that means that institutions can actually really focus on providing the best financial services that they can, as opposed to huge headcounts about some of these really inefficient non-digital processes that blockchain can solve for. And I think that's definitely an area where, as a tip, I guess, people are never going to be interested in things they don't understand. And I think about all the places that banks are moving, like on the cloud, for example, making it really easy and digestible, and leading with where can the bank benefit, as opposed to really having to educate them about the entire tech stack of what it is that you've built. I know that Ostium and Spectral have been really great at how they communicate with those types of institutions, which is awesome. So lightning round, because we're done. I'm going to just say a term, and then if each of you could say the first word or thought that comes to your mind after I say it. Are you guys ready? So the first one is rebirth of assets on chain.
I guess potential.
M2.
Rebirth was the rebirth of assets on chain. Native on chain issuance.
So the second one, blockchain eats asset administration.
Blockchain eats what?
Asset administration.
Oh. Long overdue.
Back officer, fund admin.
Dex.
Awesome. Well, that is the lightning round. Really awesome to have, had this conversation with you guys. Any last thoughts or tips for builders or investors out there before we wrap up?
Yeah, I guess for like builders, I think like we talk about real world assets, and it's important to, like, as you're building, like, part of like startups and startup cultures, like you find like a passionate niche and you like build for them. But I think in this industry, it's like such a like disparity between like normies and like native Web3 users. So as you're building, start thinking about like the next wave of people coming in and using these products. A lot of what we talked about is like bringing assets either on chain or bridging them back into the real world for use case that makes them accessible. But you have to understand like the diversity of users around the world and their accessibility to current financial services, and then how will they use them. And I think that's going to be important over the long run.
Yeah, I would say just take the long view. My view, sort of where we are is where cloud software was 25 years ago. And this will be a 20, 30-year journey. And sometimes it'll feel like there isn't much progress being made, but like keep at it. Because like this is, financial institutions are really slow. Anyone that has ever sold anything to a bank knows it could take like 2 to 3 years, and like that's what's going to happen here, especially in real world asset infrastructure. But I think incrementally the adoption will be there, and then suddenly it'll take off, right? Once you sort of have all these ancillary infrastructure and services ready. And like it may seem like banks or asset managers are pushing back now, but it looked very similar to that like in the 90s with traditional incumbents. And so like they are sneakily working behind the scenes to either build or adopt some of these things.
Yeah, I would echo what Nick said while adding that I think when you're building something in the real asset space, right now, there obviously is an intermediate stage before all of this stuff is widespread and adopted by institutions where you need to solve an immediate problem. And so thinking through what the longer term vision is while also making sure that you're addressing an immediate need of consumers. So for us, the way we've thought about that is ultimately we think that all of this stuff will be traded on chain, but in the immediate term, the problem we're solving is allowing on-chain diversification for investors that want to diversify into other asset classes without having to offboard their capital, put it in a centralized institution, and deal with all that complexity. So I think tying in early on in your product design the immediate problem that you're solving while also thinking through how that'll tie into evolutions in the product in the long term so that you can actually evolve this product progressively rather than having to scrap entirely what you built early on and rebuild for the future. So, yeah.
Awesome. Well, thanks you guys so much, and thanks everyone for listening.